What does it mean to buy a property subject to in real estate? Put very simply, this is when a person buys a property subject to the existing mortgage. With the subject to, the title of the property is transferred to the new owner, and the new owner commits to paying the monthly mortgage payments, but the loan remains in the name of the seller. Let me give you an example. Joe is behind on his $150,000 mortgage and is facing the possibility of foreclosure. An investor discovers the opportunity, evaluates the home, and determines its current market value is $175,000. In order to avoid a foreclosure and screwing up his credit, Joe agrees to sell the property to this investor subject to his existing loan. At closing, the investor gives Joe $25,000 and Joe simply transfers the deed over to the investor, and the investor takes over Joe's monthly mortgage payment. Joe is happy because his default is cured, he avoided a catastrophic credit hit from the foreclosure, and he gets the benefit of continued regular monthly payments on his credit report. And the investor is happy too, because they got a loan on the property without the hassle and expense of obtaining a new mortgage. Now, to be clear, subject to is different from assuming a mortgage. A mortgage assumption is when the seller's name is removed from the mortgage and the new buyer becomes directly responsible to the lender. Under an assumption, the new buyer has to go through loan qualifications just as though they were applying for a brand new loan. By contrast, with subject to financing, the seller remains on the loan, which means they are still technically liable if the investor stops making payments. This is a major disadvantage to selling property subject to, and what's worse is that in many cases, mortgage contracts give lenders the right to call the note due if a property is sold subject to. This means that the mortgage lender can demand the entire loan amount be paid right now if the deed is transferred, and if not paid, they will initiate a foreclosure. Now, even though a bank may have this right, many lenders won't enforce it just as long as the loan isn't in default. If payments continue to be paid on time, the lender has little incentive to call the note due. So fortunately, when it comes to a property being sold subject to, many lenders will just simply turn a blind eye. That said, it's still a huge risk for the investor, especially if they don't have the cash to cover the balance if the note is called due, or if they can't get refinancing from another lender. Property insurance can also create some major challenges. Sometimes a change in policyholders is all that it takes for the note to be called due. Taking out a second policy could cause problems as well, because each insurer would attempt to pin the cost of the claim to the other. The easiest solution is to retain the original policy and simply add the new owner as an additional insured. One additional risk to buying subject to is that the seller could file Chapter 7 bankruptcy at some point in the future. If the home equity is above the exemption limit, the trustee can force a sale, causing the new owner to lose the property. So you might be wondering, with all these risks for both the buyer and the seller, why would anyone agree to buy or sell a property subject to? The answer is distress and motivation. For example, say an elderly woman needs to move into assisted living. Her home is in poor condition and her family lacks the time and money to fix it up in order to get it sold. The woman needs the money like right now in order to pay the move-in fee for the assisted living center. With a subject to sale, the investor gets an advantageous price for taking the property as is, and the woman gets her money right away so that she can move. It's a win-win for both parties. Want to learn more about subject to deals and how to structure them? Be sure to check out the full article on retipster.com. See the link beneath this video. Subject to financing is definitely not the right fit for every real estate transaction. If you're looking for an alternative, but you still want to use creative financing, check out this next video where we're going to discuss another option worth considering. Go ahead and check it out right now, and I'll see you there.